Hi, this is Natalie, and you're listening to the Mental Money Podcast. If this is your first time here, welcome, welcome, welcome. If this is your second time here, or if you're coming back, thank you for coming back. I don't know why you're doing that, but thank you. No, I'm just kidding. Thank you for coming back. Today we have with us Kasey Green. She's a tax strategist, and thank you, Kasey, for coming.
Thank you. I appreciate you having me.
Yeah, of course. So, as a strategist myself, um, talk to me. You are a woman after my own heart. I love a good strategy. I love a good plan, a good roadmap, a good way to like conceptualize things and understand what I'm doing before I get things done, right? And taxes are one of those things that are a necessary evil in our business.
Yeah.
Necessary and evil, emphasis on evil. But it's kind of one of those things where I feel like businesses get caught up a lot.
Yeah.
So maybe let's take it real far back because we talked to a lot of like newer businesses. So
Yeah.
what should we think about when we think about creating a tax strategy before we even incorporate? Like what's the first high level thing we should think about doing?
Definitely. So, high level, before you even get started, don't jump into incorporation. Let's discuss entity optimization. So
Okay.
many people just jump into an LLC. I think it's kind of been bred into us that an LLC is the best way to go, and everyone just jumps there. So, we need to really have a plan on is that going to be the best option for you? Should we look at S Corp, C Corp? What are my other options that may be better for your business plan?
Okay. So what are the differences between an S Corp and a C Corp?
Yeah. So there's an LLC, an S Corp, and a C Corp. An LLC is what the government considers a disregarded entity. Love that, right? We're just disregarding it. The reason they say that is because they do, for tax purposes, kind of just forget about it. They're going to tax you the exact same way as if you're self-employed. So typically 14.5,
Yeah.
15.10%, somewhere in that range, no matter what. So LLC, self-employed, kind of the same. Once we move over to an S Corp, I like for my companies to be either anticipating a $4,000 a month revenue or to be at that point
Okay.
before you jump into an S Corp. But there's so many advantages. You're kind of your own employee and employer at that time. And so there's a ton of new write-offs, a ton of expenses, a ton of new loopholes and strategies and all the good stuff. And then a C Corp is you're actively running, making $500,000 and you're like, hey, I have to get into more corporate tax and write-offs. And that's where I'd put you there.
Okay, got you. So what is a write-off? Like, a lot of people, unfortunately, online,
Yeah.
the word write-off has kind of been diluted a little bit. So people just kind of say you can write this off, but nobody really talks about what that means for a
Yeah.
business. So can you explain from a high level what a write-off is and how that applies to us from a business sense?
Yeah. So you're right. Write-off is so just commonly used, right? We're just write that off, just write that off. And no one really knows who's writing it off. What does that mean?
Right.
So typically that's considered a deduction of expenses or losses. So for individuals, it's going to be things like medical expenses, charitable donations. With businesses, we go a little bit further. We have asset write-offs. So if you have equipment, if you have inventory, we're going to depreciate them and we're going to take a loss there. There's also things like bad debt, depending on where your financial system is. And then again, if you're an S Corp, there's so much more. There's so many loopholes and rules that you get to write off or deduct really from your adjusted gross income. So it all comes down to how far can I pull that income down so that I'm taxed on the least possible.
Okay. So, got you. So let's say, for example, if I was to owe, like the net profit at the end of the year was $100,000, for example, and instead of being taxed on the $100,000, I'd begin to deduct certain items that are designated by the IRS. And because I'm a business, I would
Yeah.
have more things that I can write off. And
Yeah.
that would lower the amount from 100,000 to, let's say, 30,000. And now I'm taxed on the 30 versus the 100.
Exactly. That's exactly what you're doing. And then that would be just an LLC, right? An LLC straight, I'm just writing it off and this is where I'm getting down to. But when we move into like an S Corp territory, if you're making 100,000, I would definitely put you, again, $4,000 a month is where I'd put you in that. So about 50,000,
Mhm.
and that's where I'd move you. At that point, there's so many tax loopholes. So not only are you getting the deductions or the write-offs, but you're your own employee and employer at that point. So there's so
Mm,
much more that you can do with it. Um,
okay,
so many really cool loopholes, and I'm not just writing things off. I'm actually getting money back in some instances.
interesting. So how would the money back work? So am I getting, like, a tax return?
Yeah, so it's really going
Okay.
to depend on you and
Mhm,
what your situation is.
mhm,
But if you're paying taxes, you're paying too much in taxes. If you
mhm.
have a business, it's just kind of the way it is because you don't know tax law. The IRS
Yeah,
doesn't want you to know tax law.
yeah.
that's why that's why I jump in and help you learn those loopholes. But a lot of
Okay,
times, yeah, I can pull your adjusted gross to a negative, to a large
okay.
loss, which would mean the government's paying you something to make up for those losses.
Mm. Okay. So, like, I interesting question. I had a client who was a real estate client, and he was trying to refinance on a property that I think he had flipped or something like that,
Yeah.
right? Um, so on his income, or I think he was trying to move the property from a business to a personal. So his
Okay.
income demonstrated that he only had $30,000 after all of his deductions.
Okay.
But what happened was he didn't have enough stated income.
Okay.
So as business owners who have, like, kind of weird complex tax returns like that,
Yeah.
how do we kind of make up for the fact that we don't really make money the traditional way? How does this show that we actually pay ourselves and we earn money?
Yeah. So there's so much to that, so many facets. Real estate is really interesting. When we get in there, there's specific deductions, rules, loopholes that are only for people who own one more than one house, people who
Right.
are in that market where you said moving between business and personal, that's when trusts get involved and all sorts of cool things get
Mhm.
involved. But when we're just talking top of the line businesses, we're talking an S corp, someone who's small, 50,000 but still growing, you
Mhm.
actually pay yourself typically by a W 2. So I'm going
Oh,
to help you set up a whole system where you
mm,
do pay out W 2 and you're paying yourself that way. If you're an LLC, you can pay yourself just via distributions or deductions. But once we start moving and you're growing your small business on your way up, you do W 2, just like if you were going to another employer. That's the cool thing about being your own employee and employer. Rather than
mm.
getting 15%, you're then paying 7.5 as an employer and 7.5 as an employee. So you're really double dipping that way.
Interesting. So maybe I'm confused. But
No,
so
it is confusing.
okay, yeah, because if I'm paying myself a W-2, then I'm also subject to income tax.
You are. Yep. So the way that that works, if I'm an S corp, an S corp requires legally you have to pay yourself a W 2. So kind of
Right.
the downside a little bit of having an S corp. There's so many rules that it's going to outweigh itself. But an S corp, I am now self employed, so I have. Sorry, that didn't make sense. I'm now my own employer and employee. So as an employee, yes, I'm going to go through W-2, I'm going to have income tax. But because
Mhm.
I'm taking as low as humanly possible, and you work with a strategist to find out what's legally allowable for you to take,
Right.
but because I'm doing that, we like to be about a 7%. We're really, really low in what we're taxed. And
Mhm.
then you're only paying 7% as an employer. So though you're
Mm.
paying taxes, you're taking a deduction for it because you're paying it as an employer. And you have to pay
Right.
the payroll tax. That's an expense that's taking a loss on your business. And then you're getting it here. Yes, you are paying some tax into it, but you're paying 7%. You're not paying 15. And beyond that, let's say I can get you down to 15,000 is the reasonable comp. We can legally get away with paying you. I paid that over the year. S corps allow for untaxed distributions, which means
Mm.
now you are paying tax on 15, but compare that to having an LLC making 40 and paying 40 on that. I would only be paying 15 and 7% on 15, and I can pull the rest via tax-free distributions. Huge
Gotcha.
savings.
Okay.
Confusing.
Gotcha. Okay, I think I understand the difference now. So, either way,
Yeah.
so LLCs pay more in taxes up front, and then S corps technically pay taxes twice in a roundabout way, but then the distributions is the way you offset that
Yeah.
with like, a legal limit, the lowest legal limit. So then
Yeah.
when I'm so kinda back to my original question
Yeah.
about stated income, when I'm demonstrating how much I made that year, let's say I need to purchase a personal property.
Mhm.
It's gonna show that I made the legal limit that I can get on a W-2. Will I qualify for that property legal, income-wise?
Yeah, so you'll have 2 different things that you'll report when you're buying. You would report all of your business, and so typically they will look at revenue. They won't necessarily look at net, so everything after expenses. A
Okay,
lot of times they will wanna look at your tax. So if I was looking at your tax return as a bank, you had that your income was whatever 15,000 that we got away with. Well, you also have business income, right? So let's say that we had 100,000 in business income, like the earlier example. Though you don't want that, you want to take all the expenses. That still shows as that's how much you had come in. Then you have
okay.
your adjusted gross, which means now I've taken all my expenses. So you
Mhm.
are able to kind of make that work. You're looking into loans, when you're looking into all of that, we can show this is the income. We just have this many expenses. Just like if I had to apply for a credit card and they ask how much my rent or my mortgage is. Kind of the
Right.
same thought process there.
Right, got you, okay, got you. So, as far as okay, so we talked about tax structure, we talked about, a little bit about how the payouts work.
Mhm.
What about, no, let me ask you this instead. What are some other tax strategies that we should try to think about before we start as well?
Definitely. It's really complex, so it really depends a lot on your area. Real
Mhm,
estate has so many different ones,
mhm,
physicians, it really is gonna depend on you, but if you're over that 4,000 mark, there's some great ones for S corps, and that's where I really push all my small businesses to be, and
mm,
when we go into that, there's a lot of deductions. For example, just throwing one of the cool loopholes out there, there's a
okay,
loophole called the Augusta strategy.
okay,
What that is it's based from Augusta, Georgia, when the horse race, is that what it was? When everyone's coming in and way back when, the Derby.
okay,
And so everything was rented out. So businesses who would
mm,
normally go get a conference room couldn't. There was no space for them. So what
okay,
the government put into place is you wanted to go get this conference room. You were going to pay $100 to have your board meeting and have all your members go meet you there. But
okay,
we couldn't. We were sold out. So now we'll make this rule where you can have your board meeting in your own home and you're paying, your business is paying yourself for the board meeting. So you can do that up to 14 days a year. So what I would do is I would pull comps in your area. So what is a normal conference room? If you were to go to a co-working space and needed a conference room, what is that going to cost you? If
okay,
it's 500, I'm going to take that and now we're going to have board meetings, even if that board meeting is you and you. It's really you just going through everything and saying, okay, during this board meeting, I talked about, do I need a tax strategist? During this board meeting, I talked about, should I take this much in W 2? We make those adjustments, we go through it, we write everything down, make the records, and then we transfer this much money, 500 from your business to your personal, even if that means I'm putting it from your personal to your business, then back. It's just about showing I put your business to your personal and I paid myself. So then
mm.
every 14 days out of the year, I'm paying myself $500 for that. So think of a nice
So,
deduction.
the government allows you to pay yourself for that?
Yeah, that's that
And that's
rule.
tax-free?
It is. So not necessarily tax. You're not taxed on it, right? Because I'm paying for a conference room. It's a
Right,
service. I'm not typically taxed on that. If I was to go get the conference room, I'm
mhm,
taking an average. So
right,
whatever they were going to charge me, I'm using that to kind of show what my reasonable amount
gotcha,
would be.
okay,
So for that amount, just like if I was paying your business, if I was paying for your services, I'm just paying it, right? And you're taking that as income, but you're also taking it as a loss. So my business is taking a $500 loss because I needed to pay for a boardroom. And
okay,
then I'm getting the income from it straight over and I get to deduct it. So
okay. So, 2 questions. How would
please.
you categorize that expense?
It's called the Augusta rule. So
Okay,
it's categorized under a loophole within the tax law.
right, no, so my question is, like, when I
Oh,
go to categorize, like,
you're
literally
fine.
categorize it, right? So
Yeah.
what does it fall under?
Yeah. So like your accounting, financials,
Yeah.
QuickBooks,
Mhm,
wherever.
yeah,
Yeah, it depends on how you have it set up. Typically, an office expense, a rental space, anything
Okay.
in that realm is where you would typically put it.
Okay. And does this meeting require minutes?
It does. So that's one of the
Mm,
things that your strategist does
okay.
is we go through and we show you what those minutes should look like depending on
Okay.
how who you're working with. I have a whole template that we use together so that we
Okay.
can put that down and you just record. I mean, mine has boxes. So did you talk
Okay.
about this or this or this? And it took place at this time. And that's kind of how we go through it. There's a
Right.
record of minutes, there's a record of the transfer, and it's a
Okay.
loophole.
Oh, interesting. And does the meeting have to be a certain amount of time?
No, no, we typically advise about 45 minutes that you put down there. But again, these meetings are taking place, right? They're not,
Yeah.
you could be talking to yourself, to your advisor,
Right.
to me. And that's where you're getting the deduction for doing
Got you. Okay. And this is
that.
14 days out of the year.
Yeah, 14 full days. So 500 times 14, and that's just a deduction for you.
Interesting. Okay. What else like that exists?
There's so
What
much.
do you need to
There's so many really cool things. That's what I'm here for, right? There's so many really cool plans. You can hire
know?
your own children, pay
Mhm.
them up to 12,000 a year. I
Mhm.
mean, there's so many cool things I could just.
How are people deducting or like expensing their like clothes and stuff? Like we know
Yeah,
that that's a thing, but
yeah,
from some my content mentioned like it being having like a some kind of like moniker or logo or something like that inside of it. How does that work from like an influencer or content creator standpoint? Because I know a lot of influencers and content creators are doing that now where they'll try to like expense their makeup, expense their
yeah,
like getting their lashes done, getting their hair
yeah,
because it's part of their content creation
yeah.
or GC line of work. So how does that
Yeah.
work now?
So there are some really tricky. So if you're saying I'm an influencer, I'm just starting, so I'm just self-employed, I'm 1099 if I do an influencer deal, I'm just kind of moving along, right? If that's what you're saying, then there's very limited that you can do.
Mm,
If you're trying to do makeup, I mean, you really have to prove that these were things you couldn't do your job without. Like the job
okay.
requires it. It wasn't personal. You would never use it on personal, that it was
Mm,
just for this. So it is pretty strict. Your accountant's right when they're saying, well, is it monogrammed? Is it this? So that's the way
mhm,
it works if you're just hanging out on that level. So if you're like, I'm going to stay self-employed, I'm going to stay LLC, but when you're growing, if you're an influencer making 60,000 a year, we need to talk about moving your corporation because then remember you're your own employee. So
yeah.
if I worked for you, then you would have to pay me back. If I had to go buy something, if I had to go buy this specific outfit for this brand, you would have to pay me back regardless of whether or not I
Right,
had a monogram. You have to pay
right.
me. So when you're your own employee, it's different because then I can give you a full $50 for this because I had to pay
Right.
you back for that.
No, that makes sense. Okay. Interesting. And does that count for things like equipment too? Like let's say someone wanted to buy like an iMac and they're just like, I need this for editing. Does that count?
Yeah. It accounts for everything. I mean, it accounts for I had to go do a printer. I had to I mean things like mortgage interest. I'm working from my home, so I'm going to take
Mhm.
this back. I have to put this much utilities. My cell phone is even if it's a family plan, my portion of the cell phone's $60 because I'm your employee. You need to pay me back for that because that's what I use. So it
Right.
counts for I mean, I have a huge list. It's endless.
Right, right, right. Okay, that makes sense. So talk to me about depreciation because I think that's another
Yeah.
thing that people kind of opportunity that people really miss on, especially
Yeah.
when they purchase new equipment. Can you
Yeah.
explain how depreciation works?
So there's quite a few different depreciation methods, and it also
Mhm.
depends on what we're speaking about. So
Right.
equipment is a little bit more straightforward. There's typically basic or straight line depreciation. It's just that it's a straight line. It started at this cost, it should depreciate at this, and it's every year that's what it works. If
Okay.
we're talking about more large things, if we're talking about a car,
Mhm.
the rules get a little bit more hectic. There's so much to it. I mean, even down to the color sometimes of the car can
Interesting.
can affect it. And then
Okay.
if we're talking about a house, if you're talking about like you said the realtor who had a
Mhm.
different house, if you have a house that you don't live in, oh my goodness, you need to talk to his tax strategist now
Yeah.
because Trump put so much into place. And now that
Mhm.
that's expiring, you went from 100% for the last few years to it's
Yeah.
expiring. So you only have 80% bonus depreciation. But the amount, I mean, if you own a home you don't live in, if it's in the 500,000 mark, I can tell you right now, $40,000 that I could save you just based off the one home. It's
Right.
crazy how much you can do on depreciation, but it
Yeah.
depends on the asset. Smaller
Yeah.
assets have smaller amounts, right?
Right. So depreciation is like taking the value of it and kind of spreading it like you're writing off the value of it over time?
Exactly, exactly.
Okay, got it.
If you buy a brand new microphone, you spend $50 on it today, it's not worth $50 next week. Or I'm sorry, next year. So we're gonna probably not next week either, but next year is when we can start depreciating it and saying it's worth less and less and less because I'm continually using it.
Got you. So would that be like the anticipated value of what it would be in, let's say, 5
Yeah.
years or something?
Yeah, sort of. It depends
Okay.
on the item, the equipment,
Okay.
but yeah. So typically, if you place it in service that year,
Mm,
that's when we take the value. And this is what the valuation is, and this is how much it's going to appreciate based on tax rules, based on tax
mhm,
law of this is what's applicable and this is what will work for that item. There are other options. There is advanced depreciation where you take it right up front and you
mhm.
can write off the whole thing, but then you're getting into what's the difference in savings? Is it worth it? That's where that strategy comes into place.
Okay, got you, got you. Okay. So what else should we know? Because I'm thinking about, like, I'm just looking through my tax return. Let's talk about schedules. Why
Schedules,
not?
all the schedules.
Yeah, let's talk about
Um,
all
yeah,
of
yeah, there's a lot of them, right?
Mhm,
1040 is normal. That's
mhm.
I'm doing, I guess there's not a normal. That sounds silly, but 1040 is standard. If you
Mm,
are a W-2, if you're 1099, you're doing a 1040. And then
yeah.
Schedule C is what you're going to do when you start bringing in business, when you start doing business taxes.
Mhm,
From there, there's so many different amendments we have to tack on, so many
mhm.
different extra schedules based on the rules that we're using.
Yeah. Mhm,
So once you start getting more complicated, this is when I say there's so much of a difference between a tax preparer and a tax strategist. Because
mhm.
you could give everything over and just say, here, take my taxes, file, and they will. And if you have
Yeah,
great accountant, or if you're doing your books and they look great, you'll get some back, right? They'll see
yeah,
here's a write-off, here's a deduction, but they don't go into loopholes, they don't go into laws because that's not
yeah.
a once a year thing. That's a
Mhm.
continual.
Continual, yeah.
Yeah.
Yeah. Okay, so maybe the better question is record keeping,
Yeah.
right? Because I think that's another place where people have a really hard time, with making sure that there's not things like commingling or
Mhm.
even categorizing things
Yeah.
correctly. Do you have any, like, bookkeeping
Yeah.
strategies or tips that we can kind of employ, or, like, ways
Definitely.
to parse out our bank accounts that make sense for us as not newbie entrepreneurs?
Yeah, yeah. As you're going, a lot of people who are 1099 or self-employed or
Mhm.
in the LLC realm are operating, just like you said, kind of commingling, are
Yeah.
operating based on their personal. And I always want to cut that right off. I don't want to
Mhm.
commingle anything. I want to keep them separate. I do a lot of fractional CFO work. So
Yeah,
I jump into companies who can't quite afford a CFO and just need someone
yeah.
who's really experienced, and I get to see and look into these books on how are things categorized. It's so
Mhm.
important to
Yeah.
track every little tiny expense, to
Mhm.
track your income, to really categorize everything. And I mean, then we get down to, I mean, we can go into a whole separate thing with, is your EIN growing? Do you have credit on your EIN? What does that look? Once you're categorizing and you've separated these accounts, what is the next step? What does that mean? How do you read a P&L? So
Right.
much to it.
Right. Yeah, so what are some standard things that, you would be able to see as far as, like, statements? So,
Yeah.
let's say someone's bookkeeping is up to par, like, they're really good about categorizing everything. Well, before we even go there, how often should someone go into their bookkeeping or their records and really assess what's going on?
So if you're doing it yourself, then take a few minutes a day. If you can't
Mhm.
do that, carve out 1 hour a week. Some of my clients call it their Money Mondays, and they have an hour where they go through their entire books and check everything.
Yeah.
If you have an accountant, they should be going through it probably daily. But if you can't, go through it once a week. I need to make sure that every single item on my bank statement matches on my profit and loss or my reconciliations, that it matches exactly against what I have. And
Right.
that's so important. If you
Mhm.
see something commingled, it's so important that you have a category that's a loan in, loan out from your business to
Mm.
your personal. And so you're transferring the money versus just commingling the assets.
Right. Yeah, no, that makes sense. Okay. And then my other question was, now, assuming you have all of those things in place,
Yes.
um, what statements should we be able to generate after all our bookkeeping is good and like clean?
Yeah, the most important are the profit and loss and the balance sheet. And then
Mhm.
the income statement, I'd say, is number three. Profit and loss is just that. It's going to say
Yeah.
where your profit is, where your loss is. It's going to really drill down into, you should be able to see all your expenses, the
Mhm.
categories of them, what's gone up and down month over month. And
Yeah.
that's what we're going to see there. And then balance sheet goes hand in hand, because that's going to be the balance of everything. So that's going to be any loans that you coming out, including car loans, any business credit cards, any liens, any business loan, anything that's moving. It'll also go over your balance of things like marketing. If we put a budget on marketing spend, then what is our realized number? And that's where
Yeah.
we're going to really start digging into those numbers.
Yeah, no, that makes sense. Okay. Um, like I mentioned, I'm a strategist too. I'm really big
Yeah.
on the financial piece.
Yeah.
I don't necessarily focus on the tax element of it. I happen to
Yeah.
understand taxes because I've been in business a long time.
Yeah.
But um, I want to know. I want to get your take, and I want to see how you feel about this, because this is how I feel about it. As far as like looking for like certain data points. So like let's say we're looking at our bookkeeping, our
Yeah.
records, or we are looking at our profit and loss or our balance sheet or whatever. What data points should we be looking at, or trends should we be looking at, as far as understanding like a healthy financial history or projections?
Yeah. Any large highs or lows is going to be the first. That's where I'm going to see. So if I was doing a solid 5,000 and one time I went down to three, even 4,000, that's a huge red line. We don't want to
Yeah,
see that. One
yeah.
of the things I like to see is budgeting. So
Hmm.
every month or even once a year, you should really put budgets on everything. So I
Yeah.
should really see that everything from loans to marketing to expenses, you should really put a budget on, this is what I want to hit as I go. So as my revenue grows, my marketing is going to grow. So I plan on it growing $50 a month. So
Yeah.
that would be your budget. And then where we would see the red line is where that doesn't meet. If it comes in
Mhm.
high, why did it come in high? And what is the return on investment for coming in high? And if it comes
Mhm.
in low, that can also be an issue, because why are we coming low? Is it great because we have clients coming organically? Or
Yeah.
did we not just follow through with the piece that we needed to do marketing and we've let an ad spend go wrong?
Yeah. Okay, got you. Yeah, no, you nailed it. Okay, good. So
I'm
I
glad we're on
like
the
to hear
page.
it from someone else, because when I say this to people, they're just like, "Uh, you're just that lady that says those things, right?" So, I'm glad I'm not just the lady that says those things, and, like,
No,
there's
I'll say the same things. We're both the
okay,
lady who says the things.
perfect. Thank you. So, okay, good. I think you hit almost everything that we could possibly hit, Kasey.
There's
Yeah,
a
I
lot
think
to it.
there's a lot to it. There's a lot more, but like you mentioned
Yeah.
earlier, a lot of these are, like, very industry specific, and then it
Mhm.
depends on the company's goals and where they are
Mhm.
financially, how new they are, where they
Yeah.
wanna go, and what they project they're gonna do. So, if you have any questions for Kasey, she is offering a audit and assessment of your business right now and your taxes. So please tap in, because damn near nothing is free in this country anymore. Okay, y'all. Nearly nothing. Okay, so go ahead and grab your opportunity. I will leave that somewhere in the show notes where it's available, so you can grab that opportunity. I'm also extended an invitation to Kasey to join the six-figure grant winner community. I'll also leave the link down there too, so she can do an expert-led session for us, and you'll actually be able to maybe talk to her more one-on-one too about your tax strategy. Yes, that's what I meant to say.
Yes.
Okay, so in that case, Kasey, thank you again for coming.
Thank
And
you.
for everyone who's listening, thank you for coming back. That's it. Until next time.